Another day, another dollar. Stock Common Sense, episode 7. Here to talk about the market. If you can see my screen, we currently have the S&P 500. As you can tell with this bar right over here, it was one hell of a week. One hell of a week. For the week, we're down 2.75. Pretty major events had occurred. Nice sell-off during earnings week. We had Netflix having a tough time. We also had Charles Schwab taking a tough time, but we'll talk about those later, right? No new changes on the forefront. We're still dealing with inflation, the war overseas, still have midterm elections down the road. But with us still trying to find a balance between the ranges of 4,200 and 4,600. As predicted last week, all we can do is go down from here. Just to be transparent, I was able to buy a couple positions in SPY, a couple long-term options for 2024. I like the level we're at. We still do have a time to draw down to 4,200. But this week we'll see what will go ahead and occur. If this would have fall through, our next level past 4,200 would be right over here. And that's around 40.52, around 40.52. So this will be a big week in the market. We have Microsoft and Apple reporting. So we'll go ahead and watch and see how that goes. So let me go ahead and pull up the Russell 2000. If you can see as well, Russell 2000 currently at 1940. Also had a down week. Russell 2000 was down 3.21%. From here, if we were to continue to keep falling, the Russell 2000, which would have a ways to go, could drop down to as low as 1744. So this will be something to watch. Now, remember, the Russell 2000 is the smaller index of mid to small cap companies. So this will be something that I will be watching during the week. Let's go ahead and move on to the things that happen. Now, let me go ahead and continue. Make sure you see my screen. Yep. Okay. Let's go ahead and talk about the things that happened for the week. Now, this was news to me, and it might be news to y'all, but apparently Disney is able to operate as their own independent government within Orlando. Why this is big, or what's been going on. With Ron DeSantis, the governor of Florida, basically trying to stop or basically implemented a Don't Say Gay bill, which is intended to influence teachers to not talk about or not to influence teachers or schools to talk about sexual preferences. The Disney CEO was able to come out and basically say he's opposed of this bill. Now, with that, it looks like Ron DeSantis has a thing out for Disney and is looking to cause retribution. So what he's currently trying to do, and I believe it's gotten close to passing, is that because Disney has a special status where they are allowed to work as their own government in Orlando, he's looking to end this. This has been started within, this has been formed since 1968. So to try to dissolve this during this time would be pretty crazy, in a sense of the amount of money that Disney brings in just to that region. So this is something to watch, especially if this has any tax implications on Disney and their stock, right? With Orlando being a big hub for Disney, where their headquarters are located, this could have tax implications and could cut into revenue. So this will be something that we will be watching, with the Disney CEO Bob Chapek saying that he doesn't he doesn't approve of the bill that they were put in, basically called "Don't Say Gay." So the world we live in. Next, we also have the government relaxing up on mask mandates. Now, here's why this is on our list, right? With transportation being a big thing and, people gathering together. What this is basically showing us is that we are currently in a post-COVID world, right? All restrictions have been lifted. You're able to go into bars, go into gyms, go to all these places. So all these places that were currently closed during the pandemic, we had soft opens. We also had soft regulations. Now it feels like everything is wide open. Now the stocks that were hit hard, like Carnival Cruise Lines, you had Disney that was also hit hard with the parks, gyms, bars, travel entertainment sectors. With everything opening back up, this will allow those companies to continue to bring in post-COVID revenue. Now, the reason I bring this up is because let's say we have Carnival Cruise Line. Let's see if we can go ahead and find that chart. We'll look. This stock has been hit hard. Let's see if we can do the past 5 years. Got to as high as 72.7, got to as low as $7.08. Now it's currently at 1884. If this is a company that you do believe in, this could be something that you could shoot for, right? With levels at 26 and levels at 30. This is an interesting play, very interesting play. So this could be something that you watch down the lines. Let's even look at Delta Airlines, right? They got hit hard during the pandemic, got to as high as $63 and dropped to as low as $17.51. They're currently at $43.69. This could be another play. This definitely could be another play depending on what you see. Now, not only have they been hit hard by the pandemic, but they've also been hit hard by commodity prices as far as oil prices going up and inflation within their employee wages, right? Everybody is short-staffed, wages want to go up, and most of these companies who are already riddled with debt handle a lot of those changes. So another company to watch. Next on the list that happened last week, we have Tesla in the news. Tesla, which crushed it, absolutely crushed it with the quarter 22 earnings, right? Quarter 22 earnings. Let me go ahead and read that summary so you can see what occurred. Because if there was ever a mic drop, this was it. First quarter of 2022 was another record quarter for Tesla by several measures, such as revenue, vehicle deliveries, operating profit, and operating margin of over 19%. Our outstanding recourse debt has fallen below $0.1 billion, so basically $100 million at the end of Q1. Public interest in sustainable future continues to rise, and we remain focused on growing as fast and as reasonable as possible. Expansion of our production capacity is our core to our decision-making. Past 2 months, we began deliveries in our Model Y Gigafactory in Texas and Berlin. At the same time, we're putting significant efforts in-house of cell production, raw materials procurement, and supplier diversification. Mic drop. Even with all their challenges, even with closures overseas in China, and the new factories in Austin, Texas, and Berlin opening back up, Tesla time and time again is crushing it, absolutely crushing it. Let's go ahead and look at a couple of numbers that are big compared to Q1. Everything in the red, you can see, everything's in millions. They brought in $18.8 billion. $18.8 billion for the last year of $10.4 billion. Operating expenses, they spent $1.9 million compared to last year of $1.6 million. with the OI margin. Look at this, OI margin of 19.2 compared to last year of 5.7. Here's what that means. That means for every dollar spent, or for every dollar gained, they get to keep for every $100 spent, they get to keep $19 of that after all their expenses, compared to last year, where after every $100 made, they were able to keep basically $6. They're increasing their margin, they're increasing the productivity, they're increasing their revenues, they are crushing it across the board. And mind you, they're still not at full capacity as of yet. If you go ahead and pull up the Tesla chart, you can see just the growth within the company, right? Got to as high as 1246. This was back in November, slid all the way down to as low as $700 and has been going through the roof since we found support at that level, right? It's had an up week. Currently, they closed at 10.05, closed at 10.05. But again, this is one of those companies that if you're only seeing it as a car company, you've completely missed the point. Completely missed the point. This is more than just a car company. They're working on AI, they're working on solar, they're working on renewable, clean energy type of products. This is a whole generational tech company. Just being flat out honest. Flat out honest. Now, what else is in the news? We also have that same man, Elon Musk, trying to buy Twitter. We have Elon Musk out here trying to buy Twitter. So let's go ahead and bring this up real quick. Elon Musk, with all the money that he's made, is looking to buy Twitter for $43 billion. He is looking to take it private so he can make whatever changes it need to be. You've had some analysts say this could be a troll move. Since, I'm not sure if you know, but since Tesla doesn't have any marketing, they don't have any marketing with Elon Musk simply talking through Twitter is where he gets a lot of information out of. And it seems like a big power broker move, right? We think of not Bill Gates, what's that guy's name? We think of the owner of Amazon. Why am I blanking out today? Second. Yeah, we have Jeff Bezos, who owns the Washington Post, right? Having his own media conglomerate. It looks like Elon's trying to pull the same exact thing. Now, what his true plans are, we'll never know, but this is a very interesting move. If you go ahead and pull up Twitter and their stock, this has been a company that has not moved since inception or since they've gone IPO. So if you were to look at this, let me show you. If you had owned this company, we'll go a few months out. Let's do 20 years by a month. If you look, this company opened, IPO'd at $45. Had you held this stock since they opened, let's go ahead and draw a line. Had you have held it, show the property. There it goes, sorry. If you have held it, you would have made 20%. One second. guys, 45-1. There we go. You would have made 8%. That's a long time to hold a company only to make 8%. Now, mind you, that's 8% if you held it to this week. Had you have held it to last week to where they closed, you would have been down 14%. Man, what a week makes. What a week makes. So this company has been stagnant, not a lot of growth, not a lot of innovation. And yet Elon Musk is looking to take over this company. This is something to watch. I believe Twitter goes to the board or they report earnings Monday. Let me see. If you go look over here, let me get my little handy dandy clicker. Sorry, let's see if I can do this. Go ahead and look at Twitter. Yeah, like I thought, if you were to go ahead and look, they report earnings this week on the 28th being a Thursday. So they will discuss Elon Musk's offer to buy the company outright. I believe he does have some financing. There have been some people to try to step up and try to buy Twitter from themselves since he's come out and said that. Now even Twitter trying to adopt a poison pill. So this is something to watch, something to keep up with. And yeah, stay tuned. Now, let's go ahead and look at some KPI numbers like we do every single week. The biggest thing that stood out to me as far as KPIs was pretty light week. Very pretty light week. The one that stands out to me is existing home sales. Existing home sales. We had a forecast of 5.78, actual amount of 5.77, whereas the previous month was 5.93. This shows a decline in existing home sales. Now, why is this number more important than others? If you look right here, right, we haven't been at these levels since March 2020 during the pandemic, right? During the pandemic, we had it at 5.7 with a drop to 5.2, 4.3, and 3.9. So for this level to drop, this is showing that there is less of a demand within the home buying process. This could go back up, but the other thing that I am worried about is that this is typically during the peak seasons when we start seeing homes purchased, right? Between March and August are typically the hot times of the year for homes to be bought, especially for new existing homes. So for this to be basically pre-pandemic levels or pre-pandemic lows, this is pretty alarming. It's pretty alarming. So something to watch for, something to keep track of. For us to be before the pandemic, we'll have to get to basically 5.5, around 5.5 and 5.2. So still pretty elevated, but we are reducing compared to prior months to where we're basically averaging practically in the sixes, right? Practically in the sixes. So something to watch and something to keep up with. Unemployment, we had a uptick in unemployment claims. Our forecast being at 177,000, previous week at 186, but this week actual is at 184. This week at 184. Go ahead and look at our earnings roundup. Let me bring back up my account real quick. That. tab. So if we go ahead and look at our accounts, what we currently had that occurred that was pretty big in the market, we had the financial sections basically showing their earnings. So we have Bank of America beating earnings basically. They reported 80 cents compared to an estimate of 75 cents. Now, why earnings are big is because not only they show how they did quarter to quarter or quarter against estimates and then quarter to quarter, but they also give guidance. And with 2020 and 2021 basically being wash years, 2022 is going to be big because we want to see if those companies are being able to hold those guidance, right? We want to see, hey, if they said, if all these changes, will they still be able to hold the growth within the company, right? If you look, Bank of America has been sliding down past few days. Looks like they slid down as well, but they basically beat earnings. We also have, let's see, we have Bank of America beating earnings. We had JB Hunt Transportation beating earnings. Who else? We also have Netflix, which was pretty big. Netflix beat earnings, right? They brought in $3.53 per share against the estimate of $2.89 or $2.89 per share, but their stock got hammered. If you look at Netflix, if you look at their chart, the reason they went down is because this is the first year ever where they lost subscribers, right? You can basically call this now a pandemic stock. If you were to look, let's pull it up on here. If you were to look at Netflix, this big bar right over here, they opened the week at $340 per share and dropped down to $215 per share. $215 per share. We're going to open this back up and see where their last level, the last time they were here. You will have to go all the way back to 2018, to where they're at these same levels. That is pretty major of a drop. They went past 2019, 2018, back down to 2017 numbers. Or I'm sorry, all the way back, to early 2018 numbers. Such a drop is pretty major, especially when you know that they're riddled with debt. They're still trying to up their content level because everyone's decided to join streaming, and they're raising costs to offset some of those debt. This is pretty big and pretty major, but something that you guys should be able to watch and see. But for that to occur, as a shareholder, it's pretty alarming, especially knowing that they got to as high as $701 to drop down to $215. Earnings matter, people. Earnings matter. Now, back to the charts, or back to earnings, if we were to look. We have Tesla who beat, ASML Holdings, who also beat as well. They're the people who help make the semiconductors. We also had, who else reported? Blackstone, they beat as well. At the Dow beat as well. So out of all the companies that we did have, it was pretty positive, even though the market did go down for the week. But again, for next week, some couple of companies to watch. We have Coca-Cola, Activision, We also have Microsoft, which reports on Tuesday, as well as Google, Visa, Pepsi, even UPS, that's on Tuesday. On Wednesday, we have Facebook. Remember how they performed. We have T-Mobile. And then on Thursday, we have Applesoft, Amazon, MasterCard, and Eli Lilly. All these companies will be reporting earnings, as well as Berkshire Hathaway and ExxonMobil and Chevron Corp. So please be aware of what's in your account. Please keep up with your earnings, and please, 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 I can't stress this enough, please trade wisely and patiently, because you don't want your account to take a big negative hit over short-term trades. Okay. Now, stock of the week, another company that had earnings is American Express. Sorry. Let me go ahead and talk about this company real quick. They beat earnings this week, pulling in $2.73 compared to $2.44. American Express is an integrated payments company, right? So they provide customers with access to their products, insights, and experiences that builds businesses. It also provides credit and credit card charges to consumers, small businesses, and mid-sized companies and corporations around the globe. Its various products and services are sold to diverse customer groups through various channels, including mobile and online applications, marketing, customer referral programs, and third-party service providers, as well as business partners. Now, they make money through their global consumer services, their global commercial services, and the global merchant and network services. It operates a payment network through and maintains relationships with third-party banks and other institutions. American Express is the third largest credit card transactions behind Visa and MasterCard. So a big player within that space. The reason why they're big is because they charge, or the reason why they get so much revenue is because they charge 2.48 commission per transaction to vendors compared to 1.9 of competition. Now, this is due to the type of clients that American Express holds, right? A lot of their clients are wealthy, or I wouldn't say, most of them are wealthy or well-off individuals with higher credit scores and who typically make larger purchases, right? With their global consumer services bringing in 54% of revenue, merchant and network services bringing in 22%, and global commercial services bringing in 23%. This week they closed at $184.54, so down for the week, whereas last week they closed at $81.16 with a market cap of $136.7 billion. For their performance year over year, they are up 22.7%. 2 years is 118%. 5 year, 126%. They're currently down 23% from their high of $199.55. Now, one thing we will be watching for 2022 is the growth of their mobile payments, right? When everything shut down during the pandemic due to COVID-19, a lot of individuals were paying down debt, weren't making as many purchases, basically stacking their funds. Now, while they still made money as far as like OI and revenue, their revenue amounts did take a big hit. Let's go ahead and look at their fundamentals. If we look at their income statement and go on an annual year, if you look at 2020, their record year was 2019, where they brought in $45.1 million. And then during COVID, they dropped $37 million, right? OI basically cut in half, going from $8.4 billion all the way down to $4.3 billion. They were able to recover in 2021 by getting the OI back up to $10.7 billion. But the revenue hasn't reached those same numbers as of yet, right? Haven't reached those numbers as of yet. As far as price targets from analysts, their bull case, which is their best case, is $240 in the next 12 months. Base case is $197 and the bear case is $155. If you currently look, we're currently at 180, right? So you have some room to go either way. So this will be a company to watch, especially look at the chart to see how we do. This is a company I do like, them, Visa and MasterCard, because like I said before, the economy is open back up. People have more money in their pockets and they will be looking to spend. So whenever people aren't fearful as far as financial issues, people tend to spend more. People tend to spend more. So now, tip of the week. Here's one thing that a lot of people think they have to be experts on, and they really don't. And this is about understanding the industry that, or investing in industries that you know well. Understand industries that you know well. So for me, here's what I mean by that. For me, I'm a Nike consumer through and through. I know my shoes. I know when the shoes are coming out. I know what shoes are coming out. I know that Nike sells out every Saturday whenever they release the new Jordans, whenever they have collaborations. I know the sneaker culture like the back of my hand, right? So for me, I invest in Nike. If you were to go to the sectors, you could see, oh, well, sorry. If you were to go to the peer competition, you can see all the people that they compete with, right? So they compete with Deckers, they compete with Skechers, they compete with Crocs, they compete with Steve Madden. They also compete with Adidas, right? Adidas, you also compete with Under Armour as far as that athletic leisure. I like to go here to compare what each company is doing and what each person is bringing in, right? And also tell you guys to invest in the top company, in the best company, right? So this is currently year over year. You can see their trailing 12 months of revenue. Nike's bringing in $46.8 billion. Now look at that compared to other companies, right? Deckers Outdoors, basically $3.0 billion. Skechers, $6.3 billion. Crocs, $2.3 billion, right? These are heavy hitters within the market. And then even look at their growth, right? The revenue growth growing as high as 21.6 billion, or I'm sorry, 21.6%. This is major, very major, right? Profit margin, which is basically the OI, basically at 13%. These are things that are really, really good and things that I watch. But because I know my industry and I know what Nike is doing within their region, this helps me understand, and it helps me understand as far as their technical analysis, their analyst reports, as far as what they're doing, what to expect. But again, it's because I know my industry, I know what they're in. Let's go ahead and look at Apple, for example, as well. Or no, let's look at another one, Microsoft. We'll look at Microsoft. If you look at their peer competition, you have Oracle, you have ServiceNow, you have CrowdStrike, you also have VMware, right? With Microsoft showing up in the software industry, but if we're being 100% honest, it's not just software, right? We know that they do have their Windows, but they also serve in video games. But they also serve in services, but they also make money in video games and things of that sort, as far as different electronics and tablets and things of that sort, right? So with this company, you can tell through their competition what or how they match up against their competition. These are big things that we like to watch and we like to compare to. But again, it's because I know my industry. I know what's going on. So if we look within a sector, you have subsectors, right? So let's say we will look at real estate, right? Within real estate, you have REITs and you have real estate management and development companies, right? Let's go ahead and look at another sector. We can go to consumer discretionary. And with that, you have automobiles, you have hotels, you have household durable goods, internet, and direct marketing and retail, right? Let's go ahead and look at hotels. Let's say you work in the hotel industry. You have all these companies that are within here, right? We click McDonald's, for example. Look at their peer competition, Wendy's, Pizza Hut, Wingstop, Cracker Barrel, and you can compare and see what the company does. Again, and make your choices as far as a company you want to invest in. knowing the industry that you're in is major and gives you a leg up within the competition. You don't have to remember, you don't have to understand every industry, you don't have to understand every sector, but focus on the ones that you are good at and watch the profits roll in. So thank you for another episode of Stock Common Sense. I really appreciate you guys for taking your time out to watch the videos. Please like, share, subscribe. If this has been helpful, go ahead and place that in the comments. If it hasn't, go ahead and let me know. But all this is free information that I try to give to the people to make sure that we as a culture are advancing our studies and getting to where we need to be. Remember, I also still have Bombi Financials, to where we have a stock club, which we go over all the calls and plays that we may have. We also have budgeting. We also have real estate tips and tricks and things of that sort. And we also have business planning. But all these things are done as a service to our people, right? And at a reasonable cost. So if you guys need anything, please let me know, reach out, and I'll see you guys next week.